Imagine this scenario. You get hit with a bill you absolutely weren't expecting. Maybe, the car breaks down, need it for work, right? Or a sudden medical thing pops up. You're basically living paycheck to paycheck, savings are zero, and forget about getting a normal bank loan. That's just not happening.
Right. For a lot of people, that's the reality.
And your next payday still feels miles away, maybe a week, maybe two. You need cash, like now.
The pressure's on.
Then you see a sign, maybe online, maybe storefront. Fast cash. Get up to $1,000 today. No credit check. Feels like a lifesaver. A quick fix for a temporary jam.
It seems like a solution in that moment. Very tempting.
But what if that quick fix isn't just, expensive? What if it's actually designed in a way that can trap you in debt for months, maybe years, costing you way, way more than whatever problem you were trying to solve in the first place?
And that right there is the entry point into what so many of the sources we're looking at today call the payday loan debt trap. It's a really serious issue. Looking through these reports, these analyses you've pulled together for us, it's striking. These loans, they offer speed, definitely. Accessibility.
That's the hook.
Absolutely. But their structure, combined with these incredibly high costs, just creates this really precarious situation for borrowers.
Precarious is a good word for it.
Yeah. And one statistic from the data you shared really jumps out. For people who use these loans frequently, and we'll definitely get into how common that is, the median total fees paid over just 1 year, $458.
Just in fees.
Just fees. And the average, the mean, was even higher, $574. That's on top of whatever they originally borrowed and had to repay.
Wow. That's a huge chunk out of someone's budget, especially if they're already struggling.
It's a massive drain on incomes that are, like you said, already stretched incredibly thin.
Absolutely. And that's really why we wanted to do this deep dive. We've got this collection of sources, detailed government reports, like from the CFPB, financial analyses, like the Robinson Report, looking at Canadian data, and some really powerful personal accounts from places like the Center for Responsible Lending.
A good mix.
Our mission today is to get past that quick fix idea, to really understand the nuts and bolts, the mechanics, the true costs, the human side of it all.
Yeah, unpack what's really going on.
Exactly. What are payday loans? How do they work? Who's actually using them according to the data, not just the marketing pitch? And why are they so often called a trap? We want to use all this material you shared as our guide, really, to give you the knowledge to see this whole landscape clearly.
Okay, sounds good. Let's dive in. So where do we start? The basics. What exactly is a payday loan fundamentally based on these sources?
Right. So the sources are pretty consistent here. They define them as short-term, small dollar loans.
Okay, short-term, small dollar.
Yeah, typically we're talking amounts like, say, $100 up to maybe $1,000. One of the samples cited in the material showed the median loan size was around $350.
$350. Not a huge amount, but significant if you're short.
Exactly. The mean was a bit higher, $392. And they're explicitly designed to be that bridge, to cover a gap until your next paycheck lands.
Okay, so bridging the gap makes sense conceptually, but what are the defining features? What makes them different and, problematic?
Definitely. There are a few key characteristics that really stand out in the sources, and they're crucial. First, and maybe the most shocking, is the cost.
Ah, yes, the cost.
It's not just high. The sources use words like exorbitant, staggering when you look closely. The fee structure isn't usually presented as an interest rate, right? It's a flat dollar amount per $100 borrowed.
Like a service fee?
Kind of. Your sources show that something like $10 to $20 per $100 borrowed is typical. The median fee mentioned is around $15 per $100.
Okay, $15 for $100. Now, on the surface, for 2 weeks, maybe that doesn't sound catastrophic.
Right, that's the danger. It sounds manageable. $15.
But this is where it gets really alarming, because that flat fee obscures the true cost. When you translate that fee into what we normally use to compare loans, the annual percentage rate, the APR, it just explodes.
Explodes is right. Can you break that down?
Sure. That seemingly small $15 fee on a typical 14-day loan, that works out to an annual percentage rate of 391%.
391%. Just say that again.
391% APR. Compare that to, say, a credit card, maybe 15%, 20%, 30% APR if you have bad credit.
Right. Or a personal loan from a bank, maybe similar rates.
Exactly. But payday loans, as your sources consistently show, commonly range from 300% up to 600% APR. And in places with fewer rules, even higher. Like
that Idaho example you pulled.
Yeah. One piece of data pointed to Idaho having an average APR of 652% for a single payment loan. 652%.
That's orders of magnitude higher than almost any other form of credit.
It's like renting money at an incredibly high daily or weekly rate, basically, even though it's presented as just a flat fee. So that's characteristic one, the extreme cost hidden in the fee structure.
Okay, what's next?
Second, they are inherently short-term. The sources confirm the median loan term is just 14 days.
2 weeks.
2 weeks. The mean is only slightly longer, about 18 days. They're specifically designed to line up with when people get paid biweekly or maybe monthly.
Okay, short term. Got it.
Which leads right into the third characteristic. Quick and easy access. This is, a huge part of their appeal, especially if you're feeling desperate.
No waiting around for bank approvals.
Exactly. The sources note, often there's no traditional deep dive credit check. The main things they usually want are proof of income.
And that can be from a job or?
Yeah, or even things like public assistance, disability payments, retirement funds, different sources of regular income. And you need a bank account, usually a checking account where they can deposit the loan and, crucially, withdraw the repayment.
Okay, so low barrier to entry. That speed, that simplicity when you're stressed, it makes them look really accessible compared to, say, applying for a bank loan.
Hugely accessible. It feels easy.
And the fourth characteristic, this seems really important based on the outline, the repayment structure.
Absolutely crucial.
Yeah.
This is core to the debt trap mechanism. It's typically set up as a single large balloon payment.
Balloon payment, meaning?
The entire amount you borrowed plus that big fee we talked about is all due at once, usually on your very next payday.
Wow. Okay. Not installments, just boom, the whole thing.
The whole thing. And to make sure they get paid, the lender often requires you to give them one of two things up front. Either a post-dated check for the full amount, dated for your payday.
So they can just cash it.
Or, increasingly common, you have to give them electronic access to your bank account. You authorize them to just pull the full amount out automatically on the due date.
Okay, so they have direct access to your funds.
Yes. It's designed for a very simple, single transaction from the lender's perspective. Get money out, get it all back quickly. Simple in theory.
But in practice?
In practice, as we're about to see, that single balloon payment structure is a major, major reason why this becomes a trap for so many borrowers.
Before we really dig deep into that trap, one quick note from your sources. There's a similar product some banks have offered. Deposit advances.
Ah, yes. Good point. Some banks and credit unions have offered products called deposit advances. They're structured very similarly, short-term, high-cost, often repaid automatically when your next direct deposit hits your account. They carry many of the same risks of trapping borrowers in a cycle, though they aren't always regulated in exactly the same way as storefront or online payday lenders. It's something to be aware of.
Okay, so we've got a handle on what these loans are. High cost, short-term, easy access, balloon payment. Now, who actually uses them and why? Because this seems to be where the story the industry tells clashes hard with the data.
It really does. Let's start with that industry narrative, the sort of myth, you could call it, that's often promoted.
Okay, what's the picture they paint?
The common image is of someone who has a job, they're working, but maybe doesn't have much savings. Sometimes you hear the acronym ALICE Asset Limited, Income Constrained, Employed.
Okay, ALICE. Makes sense.
And this person, the story goes, faces a genuinely one-time, totally unexpected financial emergency. The classic examples are the car breaking down, needing urgent repairs, or a sudden medical bill, maybe a utility bill that's way higher than usual and needs paying now.
A real isolated crisis.
Exactly. And they need cash immediately because they have literally no other options. Credit cards are maxed out, bank won't lend to them. And crucially, the narrative emphasizes that the cost of the payday loan fee, while admittedly high, is justified. It's painted as the lesser of two evils. Because paying that fee, say $50, prevents a much worse outcome, like losing their job because they can't commute without the repaired car, or paying huge utility reconnection fees, plus late charges that add up to more than the loan fee, or maybe avoiding bouncing a check for rent and facing eviction.
So it's presented as a rational choice in a bad situation, a bridge over a temporary acute problem.
That's the narrative. The loan helps the responsible but struggling worker navigate a one-off crisis and get back on their feet.
Okay, that's the story. But what does the data from the sources we have, like the CFPB Pew, the Robinson Report, Kudu, actually tell us about the typical payday loan user?
It paints a very, very different picture. These sources consistently show, based on actual borrowing patterns, that the vast majority of payday borrowers are not one-time emergency users.
Not just dipping in once.
Far from it. They are frequent, repeat customers. The business model seems built on this repeat usage.
Okay, this is where it gets really interesting. How frequent is frequent? What do the numbers say?
The data is pretty stark. The Kudu source, for instance, references a study finding that something like 80% of Americans who take out a payday loan go back and apply for another one within just 2 weeks.
80% within 2 weeks.
80%. That statistic alone just blows the one-time emergency idea out of the water for most users. It clearly signals a cycle, not a single event.
Wow. Okay, so they're going back almost immediately. What about over a longer period, like a year?
The data on annual usage reinforces this dramatically. The CFPB data you included is particularly powerful here. They found the median borrower in their study, meaning half took out more, half took out fewer, took out 10 payday loans over a 12-month period.
10 loans in 1 year.
10. And remember, the median loan term is just 14 days. So if you do the math, that means the typical borrower is indebted with a payday loan for around 200 days out of the year.
200 days. That's like almost 7 months of the year they're carrying this high-cost debt.
Exactly. With only very short breaks, maybe just a few days, between paying one off and taking out the next. That is absolutely a cycle, not just handling isolated emergencies.
That really changes the perspective. What about the Canadian data? Does it show a similar pattern?
Very similar. The BC data mentioned in the Robinson report, for example, shows that almost half of payday borrowers in British Columbia take out 6 or more loans per year.
Okay, still significant repeat usage.
And it also noted that some individuals take out 16 or even more loans in a single year.
16? In a year? That's almost one every 3 weeks, continuously.
It means they are essentially rolling from one loan straight into the next almost constantly throughout the entire year, just perpetually cycling the debt.
So this level of frequency,
Yeah,
it strongly suggests these loans aren't mainly for those unexpected car repairs or medical bills, right?
Absolutely. It's the strongest indicator that for most users, these loans are being used to manage chronic, ongoing cash flow shortages. They're being used to pay for regular, predictable, essential expenses.
Like what? What do people say they use them for?
The Kudu source confirms this directly. It reports that about 70% of borrowers, 7 out of 10, say they use these loans for everyday living costs. Things like utility bills, rent or mortgage payments, groceries, gas for the car.
Basic necessities.
Basic necessities. They're using extremely high-cost short-term credit simply because their regular income isn't enough to cover their basic expenses from one payday to the next. It's not an emergency fund. It's becoming part of their regular budget management in a very dangerous way.
Okay, so if it's not just a one-time thing for most people, what are the underlying reasons? Why do people get caught in this cycle of repeat borrowing?
The sources point to a convergence of several factors. First, and probably the most fundamental, is just basic financial constraint.
The Alice profile again.
Exactly. Asset limited, income constrained. These borrowers are often living right on the edge, paycheck to paycheck, or maybe their income consistently falls just short of covering basic needs.
Do we know typical income levels?
One sample in your sources indicated a median annual income for these users around $22,000. That's quite low. And critically, they typically have no liquid savings, no emergency fund, nothing set aside to absorb even a small financial shock or manage a temporary shortfall between paychecks.
So any little disruption, or even just the regular bills coming due before payday, can trigger that need for outside cash.
Precisely. Any hiccup becomes a potential crisis requiring borrowing. Second, the sources, especially Kudu, highlight the role of what they term insufficient financial literacy.
Financial literacy, what does that entail in this context?
It's not about intelligence, it's about having the specific knowledge and skills for effective money management. Things like knowing how to create and stick to a budget, how to track expenses accurately, how to set realistic financial goals.
Practical skill.
Very practical. And critically, it also includes understanding loan terms, understanding fees, how interest rates work, especially the concept of APR, and how a seemingly small fee translates into a huge annual cost.
So someone might see that $15 fee on a $100 loan and think, okay, $15, I can swing that, without fully grasping that it's a 391% annual rate and how easily that leads to a trap.
Exactly that. They might not understand the compounding effect if they have to roll it over, or the sheer impossibility of paying back the lump sum plus the fee out of an already inadequate paycheck. They're often drawn in by the speed and the apparent simplicity.
The low barrier to entry we talked about.
Yes. But they don't fully grasp the long-term consequences or the mechanics that make escape so difficult. A lack of budgeting, no emergency savings, and maybe limited understanding of debt dynamics. It makes relying on this easily available but very dangerous credit almost feel like the only option when basic needs aren't being met.
And that ties into the third factor, which you already mentioned, that very ease of access.
Right. When you're stressed or in a bind, you need money right now. The minimal paperwork, no traditional credit check, the promise of cash in hand, sometimes within an hour. It just seems like the path of least resistance. It can feel like the only viable choice in that desperate moment, even if it leads to much bigger problems later.
Okay, so let's connect all these dots. We have the loan structure, high fee, short-term, balloon payment. We have the typical user profile, financially constrained, maybe lacking financial literacy, needing cash for basics, drawn by easy access. How do these combine to create this debt trap everyone talks about?
It's almost perfectly engineered, unfortunately. It starts with that single large balloon payment due on the next payday.
Right.
Now think about the borrower we just described, living paycheck to paycheck, no savings, income barely covers expenses, maybe doesn't even cover them fully. They needed the loan precisely because they were short on cash for the current pay period.
Right, they were already behind.
Oh, exactly. So when the next payday arrives, maybe 2 weeks later, they suddenly have to come up with the original amount they borrowed, say $350, plus that very high fee, say $50 or $60 all at once. So $410 suddenly due.
Okay.
But they're starting from the same place of financial precarity, maybe even worse, because they spent the loan money. They needed $350 just to get through the last 2 weeks. Now they need that $400 or $410 back. Plus, they need enough money to cover all their regular bills and living expenses for the next 2 weeks.
It sounds mathematically impossible for many people.
It often is. They simply cannot afford to pay back the full loan amount and cover their essential living costs for the upcoming pay period. There just isn't enough money in the paycheck to do both.
So if they hit that due date and they can't pay the full $400 back, what happens then? What are their options according to the sources?
The sources describe a few typical scenarios, and frankly, none of them are good for the borrower's financial health.
Okay, what's path number one?
Path number one is they simply default. They don't pay. If this happens, the lender will likely try to cash that post-dated check they took or trigger the electronic withdrawal authorization.
And if the money isn't in the account?
Then the payment bounces. This usually triggers hefty non-sufficient funds, or NSF fees, from the borrower's own bank. Often $30, $35 per failed attempt. Sometimes the lender tries multiple times, racking up multiple NSF fees.
So you owe the lender, and now you owe your bank extra fees too.
Exactly. And then the lender starts collection efforts. These can be very aggressive. The Center for Responsible Lending source specifically calls out that some lenders use tactics like threatening lawsuits, wage garnishment, or even threatening arrest or jail time.
Wait, jail time? For not paying a loan?
It's almost always a false threat. Payday loan debt is civil debt, not criminal, in nearly all jurisdictions. You can't be jailed for not paying it, but these threats are incredibly intimidating and are used to pressure borrowers.
That fear must be intense, and it probably pushes people towards other options, even bad ones.
Absolutely. Which leads to the second common option, and this is really the engine of the debt trap cycle, the rollover or renewal.
Rollover, how does that work?
Instead of paying the full amount due, principal plus fee, the borrower pays only the fee for that period.
Just the $50 or $60 fee we talked about?
Yes. They pay that fee, and in exchange, the lender extends the loan's due date, usually for another pay period, typically 2 more weeks.
Okay. But what happens to the amount they originally borrowed? The principal?
Nothing. That's the catch. When you roll over, none of the fee you just paid goes towards reducing the original $350 you borrowed. You just paid, say, $50, purely for the privilege of having another 2 weeks to come up with the full $400 again, $350 principal plus a new $50 fee for the next period.
So you've spent $50, you still owe the original $350, and you've got another $50 fee coming due in 2 weeks.
Precisely. You've just spent money you desperately needed for rent or food simply to postpone the inevitable lump sum payment. And because you just spent that $50, you're now potentially even shorter on cash for the next pay period, making it even less likely you'll be able to pay the full amount next time. It just digs the hole deeper.
That sounds like a guaranteed way to just keep paying fees forever without making progress.
It very often is. And then there's a third option, which the sources say is alarmingly common as well.
What's that?
Instead of rolling over with the same lender, the borrower takes out a second payday loan, often from a different lender down the street or online.
Why would they do that?
Usually to get enough cash to pay off the first loan that's due.
Ah, okay. Robbing Peter to pay Paul, basically.
Exactly. It just kicks the can down the road. But now, instead of one high-cost loan, you have a new high-cost loan. You've incurred a whole new set of fees from the second lender, and you're still facing that impossible balloon payment, just with a different company, maybe a slightly later due date.
And this is how people end up juggling multiple loans at the same time.
Yes. They get one loan, can't pay it, take out another to cover the first, then maybe a third to cover payments on the first two. It can spiral very quickly into juggling several high-cost loans simultaneously, each with its own fees and due dates.
And the cycle just repeats. Pay a fee to roll over, or take out a new loan to cover an old one, pay more fees, maybe bounce payments, and pay bank NSF fees, all while that original amount you borrowed, the principal, just sits there, largely untouched.
That's the trap in a nutshell. It's what one borrower in the CRL source called a merry-go-round of debt. You're just constantly running, paying out huge amounts in fees just to stay in the same place, never actually getting ahead or paying off the core debt.
It's really critical then to try and quantify this impact, to put some real numbers on the cost of being caught in this trap. Your sources had some examples, right?
Yes, moving beyond just describing the mechanism to showing the actual financial drain is important. The M&P source, for instance, gives a pretty straightforward example.
Okay, let's hear it.
A $300 loan. Let's say the fee is $51. That's a 17% rate, like in Manitoba. So the total due is $351.
Right.
If the borrower can't pay that $351 back on payday, MNP suggests they might pay an additional fee, maybe $40, just to renew the loan for another 2 weeks.
So they pay $40.
And now they still owe the original $351 plus that $40 renewal fee, meaning the total debt has quickly jumped to $391. And they still haven't paid back a single cent of the original $300 principal.
Wow. It escalates fast. And you can see how easily someone could end up paying fees that equal or even surpass the amount they first borrowed.
Terrifyingly easy. Sometimes multiple times over. People can pay hundreds in fees on a loan of just a few $100s.
And the CF3 data we mentioned earlier really shows the scale of this trapped usage over a year.
Right. That median frequent user paying $458 in fees annually, and the average user paying $574. That means a lot of people are paying even more than that. Hundreds and hundreds of dollars just vanishing into fees.
What about the Canadian example from the Robinson report?
That report illustrated it well, too. It estimated that someone taking out 16 loans a year in Manitoba, which we know happens, could easily pay $816 in fees annually.
$816.
And that's assuming just the basic 17% fee each time, without any extra penalties, bounce check fees, or other charges that often pile on.
Think about what that means for someone earning that median $22,000 income we saw. $816 in fees. That's over 3.7% of their gross annual income. Just
gone.
Spent on fees, achieving nothing on the principal.
It's like throwing money into a black hole month after month.
The Robinson report also had that budget impact example, right? Showing what repaying these loans does to someone's available cash.
Yes, that was very clarifying. It took a hypothetical borrower earning $1,500 biweekly.
Okay, $1,500 every 2 weeks.
If they take out a $300 loan, let's use a 15% fee, $45. So they owe $345 on payday. Repaying that $345 leaves them with only $1,155 for the next 2 weeks.
So they're starting the next pay period with only 77% of their usual income available.
Exactly. Now, what if they took a slightly larger loan, maybe $450? Let's use Ontario's higher 21% fee rate, $94.50. They owe $544.50 on payday.
Okay.
Repaying that leaves them with just $955.50 to live on for the next 2 weeks. That's only 64% of their regular biweekly income.
And this really highlights the core problem, doesn't it?
It's the critical link. If you already couldn't make ends meet on your full $1,500 for 2 weeks, which is why you needed the loan in the first place, how on earth can you possibly manage on just $1,155 or $955?
You can't. You're guaranteed to be short again before the next payday.
Absolutely guaranteed, which makes the need to reborrow or roll over the existing loan almost structurally inevitable. It's not simply a matter of poor financial planning at that point. The loan structure itself, interacting with the borrower's low income and lack of any cushion, perpetuates the cycle.
And the personal stories, the anecdotes included in the sources from the Center for Responsible Lending, they just bring this abstract cycle crashing down to the human level. They show the immense, devastating cost.
They really do. These stories are crucial because they underscore that The data points, the fees, the loan counts represent real people whose lives are being profoundly damaged, sometimes destroyed, by getting caught in this.
Can you share some of those examples? They were quite impactful.
There's Sandra Harris. She described juggling 6 payday loans at the same time. 6. Paying $600 a month, $600 just in fees.
Not paying down any principal.
Just fees, the pressure, the cost, it just became completely overwhelming. She ended up losing her home and her car because of it.
Devastating.
Then there's Lisa Engelkins. Her story is a perfect, heartbreaking illustration of the rollover trap. She took out one $300 loan. Over the next 17 months, she paid a total of $1,254 billion in fees.
$1,200 in fees on a $300 loan.
Yes. She renewed it 35 times. She said she thought each payment was like new money just to keep the loan going, not realizing she was only ever covering the fee and basically reborrowing the $300 principal every 2 weeks for nearly a year and a half. That's over 4 times the original loan amount paid just in fees.
Unbelievable.
Pamela Gomez. She had 5 loans simultaneously. She was paying $880 per month in fees. Over time, she calculated she paid $10,560 in interest and fees on just $2,500 of principal she'd borrowed across those loans.
$10,000.
The stress was so immense, she lived in fear of going to jail, that false threat we talked about being used.
These stories are they're so consistent in the pattern.
They are. Clarissa Farrar, she was working extra hours, trying so hard to qualify for a Habitat for Humanity home, a real shot at stability. She got caught in a payday loan trap, couldn't pay it back, checks started bouncing.
Incurring more fees from the bank, too.
Exactly. Extra fees from the lender, NSF fees from her bank. It completely jeopardized her chance at getting that stable housing she was working toward.
It just undermines every effort to get ahead.
Completely. And the stories of Wanda Thompson and another woman, Whitney, they talked about spending their lunch breaks literally driving around town from one payday lender to another, just paying fees to keep the loans from defaulting, falling behind on essential bills like their car payments, facing threats like having their driver's licenses revoked. It just consumes your entire life, your time, your energy, your thoughts.
And it affects vulnerable populations too, right? Like seniors.
Absolutely. There was a story of Betty, a senior citizen living on Social Security. Her monthly check was just $564. She was paying over half of that amount every single month just in fees on a payday loan, never touching the principal.
Half her income just on fees?
Half her very limited income. She needed help from social services just to avoid being evicted from her home. These aren't isolated incidents. They represent people in incredibly vulnerable situations being systematically drained by this high-cost structure.
So looking at these stories alongside the data, the pattern is just undeniable.
Horrifyingly consistent. Someone with limited resources faces a shortfall. They turn to a payday loan because it seems fast and easy. That single balloon payment, plus the huge fee, proves impossible to manage alongside basic living costs. This forces them into rollovers or taking out new loans, which leads to months, often years, of paying endless fees that bleed their income and any assets they might have. They can't cover basics, they live in constant stress and fear, and often end up losing critical things like their car, their housing, or falling into even deeper financial ruin.
Okay, so that's the classic single payment payday loan trap. But
Right.
the lenders, they adapt, right? Your sources mentioned that as regulators started putting some limits on this single payment model, some lenders shifted their strategy.
Yes, that's a really important point. Lenders are businesses, and they adapt to the regulatory environment. As rules tightened around the traditional short-term single payment loan in some areas, we saw a noticeable shift by some companies towards offering what are often called payday installment loans.
Installment loans, so like a regular loan paid back over time.
Exactly. Instead of that one big lump sum due on the next payday, these loans are structured to be repaid in a series of smaller payments over several pay periods or sometimes over several months.
Okay, now, on the surface, that sounds better. More manageable, maybe. Like you could actually budget for those smaller payments.
It sounds better, and that's part of the problem, because while a genuinely affordable installment loan can be a much safer way to borrow than a single payment payday loan, the sources draw a very sharp distinction here.
Between what?
Between safe, affordable installment loans, the kind you might get from a credit union or a responsible lender, and the high-cost installment loans offered by many lenders that either started as or still operate like payday lenders.
Okay, so just because it says installment doesn't automatically make it safe or affordable?
Not at all. That's the critical catch. These high-cost installment loans, while they're paid back over time, often carry the same kinds of excessively high annual percentage rates we saw with the single payment loans. We're still talking 200%, 300%, or even higher higher APRs being common according to Pew and other analyses.
So the cost per dollar borrowed annualized is still astronomical.
Yes, and they often have very long repayment terms, stretching the debt out for months, sometimes a year or even longer. And maybe most importantly, the required monthly or biweekly payments themselves are often structured to be unaffordable for the typical borrower who would seek out this type of loan.
Unaffordable. How do we define unaffordable in this context? What's the benchmark?
Pew's research, which you included, provides a really useful benchmark based on borrower incomes. They found that typical payday loan borrowers, given their constrained budgets, can generally afford loan payments that take up about 5% of their gross monthly income.
Okay, 5% of their income per month.
For someone at that median $22,000 annual income level we discussed, that translates to roughly $125 per month that they could realistically afford for a loan payment alongside all their other essential expenses.
Got it. So what do the payments look like on these high-cost installment loans?
That's the problem. The high-cost installment loans offered by many payday-style lenders often structure the required payments to be much higher than that 5% threshold. Payments exceeding $200, $300, or even more per month are common.
Way above what someone on that income level could likely manage consistently.
Exactly. So even though the payments are spread out, each individual payment is still too large for someone living paycheck to paycheck to handle reliably without falling behind on other essential bills like rent or utilities. It sets them up for failure just over a longer time frame.
Do the sources give an example of how costly these can be?
Yes. The Pew report had a really stark example comparing costs in different states. They looked at a $500 loan repaid over 4 months.
Okay, $500 for 4 months.
In Texas, where regulations allowed for very high-cost installment loans, that $500 loan could cost the borrower $645 just in finance charges and fees.
$645 in fees on a $500 loan.
Yes. That works out to an APR of 527%. So to borrow $500, the borrower ends up repaying a total of $1,145 over those 4 months.
That's more than double the amount borrowed.
More than double. And the way these loans are often structured, the early payments go almost entirely towards interest and fees, with very little paying down the principal.
So you're making payments for months, but the amount you actually owe barely budges.
Exactly. It keeps the borrower locked into the debt for longer, paying those high costs over an extended period. It effectively recreates the debt trap of the single payment loan, just stretched out over months instead of being due every 2 weeks. It's the same trap, different structure.
This brings up a really crucial point then. If a standard installment loan can be structured affordably by other types of lenders, why are these super high-cost versions so common from lenders in the payday space?
That question leads us directly back to the role of regulation, or maybe more accurately, the lack of effective regulation in many places. The critical insight from your sources, particularly Pew's work, is that simply changing the loan structure from one big payment to multiple smaller payments isn't enough by itself to protect borrowers.
Just making it an installment loan doesn't fix the problem.
Not if the cost is still sky high and the payments are still unaffordable. You need robust consumer protections built around the installment structure, too. Protections that ensure the loan is truly affordable, meaning the payments fit within that 5% of income guideline and that the overall cost, the APR, is reasonable. Without those guardrails, the installment structure can just become another way to package the same high-cost debt trap model.
Okay, so let's talk about that regulatory landscape then, because your sources make it clear it's all over the map.
It truly is. The rules governing payday lending, whether single payment or high-cost installment, are highly fragmented. They vary massively from state to state in the U.S. and province to province in Canada. There's no single uniform approach.
So on one end of the spectrum, what do we see?
On one end, you have jurisdictions that have effectively shut down high-cost payday lending altogether. Pew's research, which you shared, identifies 18 U.S. states plus Washington, D.C. that fall into this category.
How do they do that? Just ban them outright?
Usually they achieve it by setting a cap on the maximum allowable annual percentage rate, APR, for small loans. This cap is typically set at 36% APR or lower.
36%. That's dramatically lower than the 300, 600% we were talking about.
Exactly. At a 36% APR cap, the traditional payday lending model, which relies on those huge fees per $100 borrowed every 2 weeks, simply isn't profitable. So lenders offering that specific high-cost product tend to just exit those markets. They can't operate legally under that price cap.
Okay, so that's the strict regulation end. What about the middle ground? Places that allow payday lending but try to regulate it?
That's where most U.S. states and Canadian provinces fall. They permit payday lending, but they impose rate caps, although these caps vary quite significantly.
What do those caps look like?
In the U.S., many states that allow it have caps on the fee per $100, often somewhere around $15 per $100 borrowed, maybe a bit lower or higher depending on the state. This still translates to very high APRs, remember, often in the 300-400% range.
Very high, yeah. What about Canada?
In Canada, the provincial caps on the fee per $100 are generally higher than in many U.S. states that regulate. For example, Manitoba's cap is 17%, $17 per $100. Ontario and New Brunswick are higher at 21%, 21 money per $100. And some other provinces allow even more, up to 23%. 23% per $100.
So Canadian borrowers are potentially paying even more per loan than many Americans, where these are allowed.
In terms of the fee per loan cycle, yes, often. That 21 or 23 $6 per $100 for 2 weeks translates into APRs well over 500%, even approaching 600%.
What do your sources suggest about the impact of these different rate caps? Does allowing a higher fee necessarily mean lenders are just making excessive profits?
Robinson's economic analysis, particularly focusing on the Canadian context, but with broader implications, provides some really interesting insights here. His modeling suggests that lower caps, perhaps somewhere around that $15 per $100 mark, which translates to roughly 390% APR, can still allow efficiently run payday lending businesses to operate and earn a fair, reasonable profit on their investment. His analysis specifically for Manitoba suggested a 15% rate could be both more just for the borrower and still sustainable for efficient lenders.
So it doesn't necessarily have to be 36% or nothing. A moderately high rate might still allow some form of operation?
His analysis suggests that yes. But when you look at the provinces with those higher caps, like 21% in Ontario or 23% elsewhere, the evidence presented in your sources strongly suggests that these much higher rates allow the large payday loan companies to earn excess profits. Profits beyond what might be considered fair or reasonable.
What evidence points to that?
Several things. The rapid expansion of the big payday loan chains over the years, the significant consolidation in the industry, like when Money Mart quickly took over many locations after Cash Store Financial collapsed, suggesting they saw value and profitability there, various financial analyses looking at the company's returns. All these factors strongly suggest that the current allowed rates in many places, particularly the higher ones in Canada, make this an extremely profitable business model, likely well beyond covering costs and a normal profit margin. The fact they expanded so aggressively implies these markets were very lucrative at those high rates.
Which implies the high rates aren't strictly necessary for survival, but perhaps more for maximizing profit, potentially off the backs of trapped borrowers.
That's certainly the implication drawn by several of the analyses, and importantly, the success stories from U.S. states that undertook comprehensive reforms, like Virginia that Pew highlighted, provide powerful counter-evidence.
How so? Remind us about Virginia.
Virginia didn't just cap the APR super low like the 18 states. They enacted a broader set of reforms for small dollar loans. They lowered the allowable prices significantly compared to traditional payday loans, but not down to 36%. They mandated reasonable timeframes for repayment, typically several months. And crucially, they required affordable installment payments, likely aligning with that 5% of income guideline.
So a more balanced approach.
A more balanced, consumer protection-focused approach. And the result? Remember that $500 loan over 4 months. In high-cost Texas, it costs $645 in fees, 527% APR. In reformed Virginia, under their new rules, that same $500 loan for 4 months cost only $138 in finance charges.
Wow. $138 versus $645. That's a massive difference.
A massive difference for the borrower. And the key takeaway is that lenders are operating under these Virginia rules. The market didn't vanish. It shifted. Lenders adapted to offer small dollar credit at dramatically lower, more affordable costs because the regulations required it. It demonstrates that effective regulation is possible. You can maintain access to small dollar credit while simultaneously shutting down the high-cost debt trap model.
That's a really important finding. It pushes back against the idea that any regulation will just eliminate access entirely.
Exactly. It shows there's a path towards safer, more sustainable small dollar lending if the political will and regulatory framework are there.
Now, one complication you mentioned is online lending. People aren't just going to storefronts anymore. How does regulation handle that?
That's a significant challenge noted in the sources. Online lenders can operate across state or provincial borders much more easily. This means a borrower in, say, a state with strict rules might still access a loan online from a lender based elsewhere, potentially one that isn't licensed in their state and doesn't follow their state's rules.
So borrowers could be exposed to even higher rates or more aggressive tactics from unregulated online lenders.
Potentially, yes. It creates enforcement challenges for regulators. Some jurisdictions, like Manitoba was mentioned as an example, try to address this by requiring even online lenders targeting their residents to be licensed, and maybe even have a physical presence within the province. But policing the vast online space is inherently difficult. It remains a significant loophole and risk area for borrowers.
Okay. So we've really unpacked a lot here. What payday loans are, who uses them, the devastating debt trap mechanism, how it morphs into high-cost installment loans, and the complex, varied regulatory picture. Given all this information from the sources, what does it mean for someone actually facing a cash shortfall right now? What are the alternatives? What are the solutions, both for individuals and maybe more systemically?
That's the crucial so what question. Based on everything we've seen in these sources, there are definitely steps individuals should strongly consider before ever turning to a payday loan, precisely because the risks are so high.
Okay. What are some of those immediate, practical alternatives someone in a bind might explore first?
Well, first, they could try talking to whoever they owe money to, negotiate with existing creditors.
Like their landlord or utility company.
Exactly, or their credit card company. See if they can get a temporary extension, maybe a payment plan to spread out the cost. Sometimes creditors are willing to work with you if you communicate proactively before you miss a payment.
Okay. Wow.
Explore options with their employer. Is a salary advance possible? Can they cash in any unused vacation days for pay? Some employers offer assistance programs.
Borrowing from people you know.
Borrowing from family or friends, if that's an option, is almost always going to be much lower cost and lower risk than a payday loan, even if it feels awkward to ask.
What about their own bank or credit union? Are there any options there?
Definitely worth checking. Even if they've been turned down for a large loan before, their own financial institution might offer other possibilities. Things like a small personal loan, maybe a line of credit if they qualify, or even authorized overdraft protection.
Overdraft has fees too, though, right?
It does, and it needs to be used cautiously. But the costs, while not zero, are generally significantly lower in terms of APR than a payday loan. Especially important are credit unions, particularly community development credit unions, CDCUs. They often have specific programs designed to help low-income members with small-dollar emergency loans at much more reasonable rates. Nonprofit financial cooperatives could also be a source of more affordable options.
Yeah, what about getting professional advice?
Yes, the MNP source mentioned they offer free consultations. This points to the value of reaching out to a licensed insolvency trustee or a nonprofit credit counselor or debt professional. They can help assess the whole financial picture, provide budgeting advice, and explain all the options available, including debt relief programs if the situation is severe. That unbiased advice can be invaluable.
So those are immediate alternatives. But looking longer term, the sources really hammer home the importance of financial literacy as a way to prevent needing these loans in the first place.
Absolutely. The Kudu source, in particular, focuses heavily on this as a fundamental preventative measure. Financial literacy isn't just about knowing financial terms. It's about building knowledge, skills, and positive behaviors around money management.
What does that look like in practice?
It includes really understanding how to create and stick to a budget, tracking expenses, knowing where your money is actually going each month, setting clear, achievable financial goals, and crucially, building the habit of saving, even small amounts, and planning for unexpected expenses or income dips.
So the goal isn't just academic knowledge, it's practical resilience. It's about being able to cover your basic needs consistently, avoid those chronic shortfalls that drive people to payday loans, build that essential emergency fund, however small, and ultimately avoid relying on high-cost debt for survival.
Exactly. It's about gaining control. The Kudu source suggests some very concrete steps people can take to improve their financial literacy.
Like what?
Actively learning to budget, really identifying all income and all spending, finding areas where savings might be possible, setting specific financial goals, short-term and long-term, committing to follow a budget plan, really understanding the difference between good debt that might build assets, like a mortgage, sometimes student loans, and bad debt that just drains resources, like high-cost payday loans or high-interest credit cards carrying a balance.
Where can people learn this stuff?
Utilize available learning resources. There are tons of online courses, reputable websites, books, even news articles about personal finance. Use financial tools. There are lots of budgeting apps now, online calculators. For some, maybe even considering a consultation with a fee-only financial planner if possible, although that costs money.
And the savings habit.
Building that emergency fund is probably the single most impactful step highlighted. Even if it starts incredibly small, having any cushion provides options and breaks the cycle of needing to borrow for every minor emergency. And one interesting point they made was about talking about money more openly in families and communities to share knowledge, strategies, and reduce the stigma around financial struggles.
Okay, so that's the individual level alternatives and building literacy. What about bigger picture systemic solutions? What changes at the policy or industry level do these analyses suggest could make a difference?
Several key policy levers are discussed. A major one is reducing those maximum allowable rate caps to a level that is fair and just, while potentially still allowing for responsible lending.
Like Robinson's suggestion, around 15% per $100.
Yes, his analysis pointed towards something like that, around 390% APR, as a rate that might allow efficient lenders to operate sustainably without relying on the debt trap model for excessive profits. It's a significant reduction from the 500-600% APRs common now in some places.
What else on the policy front?
Mandating affordable installment plans. This is crucial. Requiring lenders, especially if a borrower can't repay an initial single payment loan on time, to offer the option of converting the debt into an installment plan with genuinely affordable payments, like that 5% of income rule, and reasonable interest.
Like the models in Virginia or Washington State?
Exactly. Washington State's model, where converting to an installment plan comes with no extra fees, is one approach. Robinson suggested maybe a modest one-time fee, like 5% of the original principal, could be a compromise to cover administrative costs, but still make it vastly more manageable than rollovers. The core idea is mandating a clear, affordable path out of the single payment trap instead of just letting the rollover cycle continue.
And preventing further debt accumulation.
Yes, a critical piece alongside mandated installment options is banning lenders from issuing new payday loans or other high-cost installment loans to a borrower while they're still paying off an existing installment plan. This prevents the scenario where someone converts one loan but then immediately takes out another, just digging themselves deeper with multiple lenders.
What about the role of federal regulators, like the CFPB in the U.S.?
They have a significant potential role. The sources note that the CFPB's own research has documented the harmful usage patterns and the prevalence of the debt trap. These findings give them the authority and the justification to issue nationwide rules providing stronger consumer protections, potentially standardizing things like ability to repay assessments or limits on rollovers across the U.S. market if they choose to act decisively.
And finally, for people already caught deep in the cycle.
For them, it's about emphasizing and improving access to help from legitimate, qualified sources, making sure people know about nonprofit credit counseling agencies and licensed insolvency trustees like M&P offering free consultations. These professionals can provide confidential advice, help negotiate with creditors, explain options like consumer proposals or bankruptcy if the debt is truly overwhelming, and provide crucial long-term support with budgeting and financial planning to help people rebuild. Getting that expert, unbiased help is key for those already drowning.
Okay, so pulling way back now, after this really deep dive into all these sources, what's the single most important takeaway? What's the bottom line about payday loans?
I think the overarching message, repeated across all these different reports, analyses, and especially the personal stories, is starkly clear. While payday loans undeniably offer the allure of fast, easy cash in a moment of need.
Which is tempting.
Incredibly tempting. But their fundamental design, that combination of a single large balloon payment due very quickly, coupled with extremely high fees translating into astronomical APRs, makes it dangerously easy to fall into a high-cost debt trap.
It's almost built in.
It seems almost structurally inevitable for many borrowers, and the data just compellingly demolishes the myth that the typical user is just someone navigating a one-time emergency. Instead, the data shows the typical user gets caught in a relentless cycle, paying endless fees, often totaling far more than they originally borrowed, without making any real dent in the principal debt.
And this crap doesn't just cost money.
No, it traps individuals, often those who are already financially vulnerable to begin with, in a prolonged state of financial precarity, intense stress, fear, and often leads to the loss of essential assets like cars or housing. It can go on for months or even years, dominating their lives.
And the data suggests this isn't just an unfortunate side effect for the industry, is it?
The analyses strongly suggest that for a significant portion of the payday loan industry, this debt trap cycle isn't an accident. It appears to be the core driver of profitability, relying heavily on the revenue generated from repeat borrowing and endless fee payments from those who are unable to escape the cycle.
But there is hope. There are ways out or ways to avoid it.
Absolutely. Understanding the true cost, the mechanics of the trap, the risks involved, everything we've discussed today based on these sources, that knowledge is the vital first step towards avoiding the trap altogether. And importantly, the sources also clearly point towards alternatives and resources.
Both for individuals.
Right. For individuals to build their own financial resilience through education, budgeting, saving, taking control before a crisis hits.
And for those already struggling?
And for those already caught, knowing that help exists through reputable debt professionals, and that in some jurisdictions, more affordable and manageable loan structures are becoming available due to regulatory reforms, there are paths forward.
Which brings us, I think, to a final thought. Something for you, our listener, to really consider, based on everything we've explored today from these sources. Given the overwhelming evidence presented here, the data showing that a huge part of the payday loan industry's business model seems to rely directly on borrowers getting stuck in this high-cost, long-term debt cycle.
Yeah.
And considering the analyses like from Robinson or the reforms in Virginia, suggesting the industry can still be viable, perhaps even profitable, at significantly lower rates and with much more consumer-friendly structures like affordable installment plans. What does this fundamental discrepancy tell us? What does it suggest about the ethical responsibilities or perhaps the lack thereof of both the lenders choosing to operate in this high-cost model and the regulators who are tasked with overseeing this market and protecting consumers? It's a really challenging question, I think, worth contemplating as you digest all this information.
It really is a crucial question to ponder.